Federal Reserve has stolen more money from ordinary citizens than every single financial scam in history, and it's about to get worse. Since 2008, they've printed over $8 trillion out of thin air, and AI is about to accelerate all of this. So in this video, I'm going to explain to you exactly how this mechanism works, why they're scamming ordinary citizens, why this is going to get worse, and what you can do to protect yourself. So let's get right into it, guys. Central banks are robbing you, the $8 trillion crime no one talks about. The catalyst, how the money printer got turned on. Well, between 2008 and 2022, the Federal Reserve printed about $8 trillion out of thin air, and they pumped it right into the markets, right? The reason they did this is because there was serious emergencies in each catalyst. You can see here by the chart, we have the 2008 crisis. They had to print a lot of money for this. They had to save the economy. And then 2020 as well with COVID, they have to save the economy. There was a freeze in the financial markets. The best way to unfreeze the plumbing is to just put some liquidity inside, okay? It 10x'd since before 2008, which was about 900 billion, all the way to the end of COVID, which was nearly 9 trillion. That's a 10x in the balance sheet, okay? That's literally like a meme coin in crypto. It's crazy, and this is the financial economy that we're talking about, okay? So what happened was that everyone that already owned assets became dramatically richer, and everyone else just fell behind. The system worked exactly as it intended to. Now, 2008 was the first round, as I said. So the housing market collapsed, banks were holding toxic debt, no banks knew who to trust. You couldn't borrow from other banks because you weren't sure if they were holding toxic debt. This wasn't like publicly known things, okay? So there was no trust in the system. The Fed had to do a lot to solve this problem as soon as they could. The first thing they did is they dropped rates to zero, but that wasn't enough. So they carried on buying bonds directly from the banks, flooding the market with money, and they've just printed this money out of thin air, by the way. So they just bought the money, they bought the bonds from the bank with money that they printed out of nothing. They're the only financial institution in the whole world that can print dollars out of nothing. And they called it quantitative easing, so QE. So the initial intervention is widely regarded as a genuine emergency. It had to happen. But then previous rounds of QE weren't warranted in many people's opinion, including this guy, Mr. Hohen. Okay, we're going to get to him. So a lot of people agreed it wasn't a bad thing. Okay, it was a bad thing, sorry. The economy started recovering in 2009, but they carried on making different rounds of QE in 2010, 2012, 2014. So the emergency response that began in 2008 became the default response, okay? Now, there's a really good book that I've read. It's called The Lords of Easy Money. It basically explains what was going on inside the Fed during this period. If you haven't read it, I really recommend you read it. And there was a guy, Thomas Hohen. He was the president of the Kansas City Fed in 2010. And basically how the Fed works is that they have kind of a board and they will discuss what cutting rates or different kind of measures would do to the economy, and then they vote on it. Now, this guy was the lone dissenter for every single vote during this period when people were voting for quantitative easing. He was the only one that voted against quantitative easing because he kind of figured that the risks outweighed the rewards, okay? It just wasn't worth it. So he outvoted something every single time, and everything that he predicted eventually came true, and it's what we're seeing now, and it's about to get worse. Then COVID hit. I know you're all old enough to remember COVID. What happened in COVID, essentially the system broke. Massive pandemic, people were very scared. There was no liquidity moving around. All assets, we had a deleveraging event when all assets sold off. The Fed had to print money. The economy came to a standstill. If they did nothing, the economy would literally collapse, okay? So they ran the same playbook. Now, let's have a look how much they actually printed. When you hear people talking about money printing, this is generally what they mean, okay? So we got the Fed balance sheet. Now, this is essentially the amount of money that they've printed. It's the balance sheet. It's how many assets they have in their balance, okay? The higher this goes, the more money they've printed, okay, essentially. So you can see here 2003, 2004, 2005, it's just like really gradual uptick, okay? In January 2003, we were on like 700 billion, okay? And then literally about 5 years later, and about the same time, August 2008, we were at 900 billion. So very, very small uptick in the money supply. Everything was very stable. So we went up about 26%. And then 2008 crisis happened, and they printed a lot. So what did we go on? So we started on about 900 billion. We peaked just after, this was in months, we peaked at about 2.25. So that was a 2.5x increase in the money supply already, which is crazy, okay? And then, like you can see here, with Thomas Hohen opposed it, they carried on printing all the way into the rest of the decade. And if we kind of see when it was the peak here, so we have 2008 all the way to 2015, that was about 5x in money printing, which is crazy, okay? And then they did a bit of quantitative tightening, which is basically a contraction in the money supply. And then COVID hit. Now COVID, we started at about January 2020, and so that was 4.15 trillion, and we ended, the peak was in March 2022, which was about 9 trillion. So that was another 2x, okay? So from before the 2008 crisis, we were at 900. We literally did a 10x in the money supply. This isn't a meme coin, guys. This isn't the S&P 500. This is a 10x in the world reserve currencies money supply. Crazy. Now you can see what's happened is that we entered a tightening period. It's called quantitative tightening, where they reduced the money supply, but it has been upticking recently as well. It's currently April 2026. It probably will continue to uptick here, but absolutely crazy stuff, guys. So like I said, they've brought down the balance to about 6.5 trillion, what I showed you there, but it's permanent. That money went somewhere, okay? That money just doesn't disappear. The money goes somewhere. So where did that money go? Well, in theory, that money should go to you. That's what the Fed wants. The Fed wants that money to reach normal, ordinary Americans to help their life. That is not what happened, okay? So the mechanism is that the Fed buys bonds from the banks get the cash. With more cash, banks lend more, businesses borrow to expand, customers borrow to spend, everyone benefits. That's the theory, but in reality, what happens is the banks get flooded with cheap cash, and they put it where the returns are highest. They put it in the stock market. They put it into gold. They put it into Bitcoin. Okay, they put it into venture capital and private equity. Okay, so the money that's meant to trickle down to the ordinary citizens just goes into assets. That's the problem here. You're not positioned to capture it. If you don't own stocks, you don't own rental property, you don't own a business, okay, it just makes everything you want more expensive. It just inflates everything, okay? So the Fed has a name for how QE is supposed to work. They call it the wealth effect, but this hasn't happened, and Thomas Hohen knew this. So the person with the 700% return over the 15-year period for the stock, that guy made all the money, whereas the second person that didn't own the stock made nothing. All they did was have their money supply power eroded. So they literally lost money. Let's have a look at the stock market. So this is the S&P 500 on the monthly chart. Now, if we have a look back all the way to 2008, you can see it was this big crash here. If we take near the bottom here and all the way to the top, it's a massive, I mean, it's literally like 5x, okay? So what you need to understand is that someone captured that value. Someone made that money. That money directly came from the policy from the Fed that we described before. So the people that had stock captured all the value or a lot of the value. The people that had no stock just got their cash eroded. That's fundamentally what's going on there. So it's very sad. Now, the COVID stimulus checks were very interesting. The stimmy checks, as we called them, right? So in 2020, the government tried something different. They tried giving money directly to consumers. Surely this would fix the problem, right? Instead of going through the banks, you just bypass the banks and give money to the people. Well, the issue is it doesn't help, okay? So let's say you have 1 million people. They get given $1,000, okay? That's $1 billion. And say they spend all of it at Amazon, which in COVID, they pretty much did. And now people are spending at Amazon a lot too. That would literally increase Amazon's revenue by $1 billion. That would increase their EBITDA by a percentage more than that, like an X percentage more than that. That would benefit the shareholders of Amazon disproportionately. So essentially what you're doing, you have a massive funnel. You've got like a big umbrella. And you've got all that money coming into the umbrella, and it's funneling down into a few small elite that have built a system to capture all of that money. So you're not redistributing wealth, you're actually funneling that wealth into the hands of a few. And that's essentially what happened here. That's the asymmetry. Savings account got punished. So the Fed was holding rates at zero for many, many years. If you were responsible, saved your money, you got nothing, okay? Because you were paid about 0.5% on your savings account, whereas inflation was running about 2 to 3% in the 2010s and hit 8% in 2022. So you were literally losing money, essentially, in real terms, if you're holding in a saving account. And we can see here what happened here. So we got 2008 quantitative easing. The money went to the Fed. First, the Fed bought bonds of the banks, and then the banks put the money into financial assets, okay? The money goes into shareholders and asset owners, okay? In 2020 COVID, they gave people money directly, but then they spent at businesses like Amazon, and then that turns into business revenue, and that increases earnings per share, and then that benefits the same people. So there's no way around this. They created, and you think this is by accident, by the way, guys. This is the whole point of the video. This is not by accident. Don't you think there were very powerful people that wanted to make a lot of money, that maybe had some connections to the Fed, or they had a large lobbying power? People made this happen to benefit themselves, okay? They don't care about you. The split, who got rich and who got left behind? Well, the bottom half of America owns 1% of stocks, okay? That's Fed data. So the top 10% own 87. That's a massive asymmetry. So the top 1% alone own half of all the stocks. So when the stock market goes up over 700% over 15 years, you know exactly who captured that gain. About 62% of Americans technically own stock. They don't own much, okay? So the concentration is so extreme. So these people, the top 1%, own 50% of all stock. And that stock went up 700% over the last 15 years. Crazy. Okay, the gap between the rich and the poor is getting wider, and it's just about to get even wider, and I'm about to explain to you why. So there's three companies that you've all heard of: BlackRock, Vanguard, State Street. They manage over $25 trillion in assets combined. Okay, they control roughly 74% of the US equity ETF market. Okay, so when money floods through the markets through QE, they take a cut of every single dollar that goes through their ETF system. They printed. BlackRock went from about 1 trillion before the crisis to about 13.5 trillion in 2025, the biggest beneficiaries of COVID. So the system that was meant to help everyone recover made financial institutions, who are the richest people in the world, way richer, like disproportionately richer, okay? And you got to remember, whoever controls the money controls the world. So essentially made the most powerful people in our society even richer. Now, the Fed's own research says what happened. So in the New York Fed staff report found that QE widened the income gap between the top 10% and everyone else by raising profits and stock prices, okay? They literally found this, pretty obvious. Hohen was right about everything. In 2010, before any data existed, he said that QE would cause asset prices to rise and would cause asset bubbles, okay? And create greater differences in wealth between people. He was right, okay? So you can see who actually gained here. So we got wages stagnated. They only went up 67% between 2009 and 2024. You have housing that went up about double. S&P 500 went up about 8x, okay? So the assets you can't afford went up 700%. So it's harder to buy the S&P now. It costs more money to buy it than it did before based on your wages. Why it's going to get worse from here? So this is the ugly part. So every single time the Fed tries to shrink the balance sheet or raise rates, the markets panic. So in late 2018, the Fed was tightening and the S&P dropped 20% in 3 days. So they reversed it. In 2020, they printed faster than ever. You think that they're not going to keep doing the same thing, okay? So essentially, they make a load of money, and then they tighten a little bit, but then something else breaks in the financial markets. Maybe this time it's going to be something to do with oil in the Straits of Hormuz. We don't know. But something breaks, and then they just print more money on top. And the floor keeps moving, okay? So like I said, in 2007, the balance sheet was under 1 trillion. In 2008, the floor was 2 trillion. After COVID, and what I mean by the floor, I mean after they've peaked in the balance sheets, like the kind of drawdown. In COVID, the floor was 6.5 trillion, okay? The next crisis is going to take that floor even higher, okay? Now, what's interesting is that interest rate payments on national debt for the US are over 1 trillion a year now. It's unsustainable. The debt itself is approaching 39 trillion. There is no way this can be repaid without devaluing the currency. This is what every single major power in the world that entered its late stage of civilization did to their currency. They started devaluing the currency so they can pay back their debt. AI and automation are making labor cheaper to replace, so your wages are not going to go up the same rate they were before, because now we have AI and automation that's going to actually start pressuring and competing with those wages. So we have a labor market that's becoming weaker. We have assets that are becoming stronger. We have a structural incentive for the Fed to carry on printing money. Everyone's going to be poor and the rich are just going to get way richer. That's what's going to happen. And the only way to solve this is to hold hard assets. The system is designed to debase your cash. Central banks target 2% inflation as a policy goal. That means your cash is going to lose money. You have to buy hard assets, okay? So to stay even, your wealth has to grow just as fast as the money supply, at least as fast. If the balance sheet goes 10x and your wealth hasn't gone 10x, there is a problem. So what I'm doing is I'm using cash to buy assets like Bitcoin. Now, Bitcoin is very volatile. You don't have to buy Bitcoin. You can buy gold, you can buy the S&P, whatever works for you. But for me, Bitcoin's the best. Simple thesis. It was created for this. It was created in 2009 after Lehman collapsed and after the chancellor bailed out the banks. It was created because someone very intelligent knew that this was going to happen to the financial system. It's hard money. You can't print more of it. There's a limited supply of it. And after quantum is all done and dusted, there is no other bad thing that's going to happen in crypto. We're going to go to the moon, okay? So the choice is yours. You can either keep your savings in a currency that loses value every single year, backed by government borrowing trillions, managed by a central bank that prints more every single time the system breaks, or you can hold something with a fixed supply that sits outside of that loop. Both carry risk. Cash loses purchasing power by design. Bitcoin and other hard assets are volatile. You have to know how to navigate them. But the choice is very easy if you ask me. Have an amazing day, guys. Bye-bye.